Hi, I'm Ling Hui with part 2 of a video series about how your financials can help you manage and drive business success. In this video, we'll focus on trading activities and working capital. Let's take it from the start of a new business so we have a clean balance sheet to build on. You put in $5,000 cash to get the business off the ground. That cash is contributed as capital. That means you took up shares in the business. You could have put the cash in by way of a loan from you personally to the business, but let's say it's capital for the time being. The business is involved in selling widgets. Let's say you start the business on the 1st of January. Your balance sheet at the end of that very first day of business would show cash of $5,000 as assets and paid up capital of $5,000 as equity. And if you looked at the cash flow statement at the end of that very first day of business, it would show that $5,000 came in as proceeds from equity raising. That's the capital you put in. That's the only transaction that happened on this day. So the net cash flow would be $5,000. At the start of the day, your opening bank balance was $0, and at the end of the day, it's $5,000. So that change in bank balance is exactly equal to the net cash flow for the day, which is how it should be. So you start trading. In your first month, you sell $1,000 worth of widgets. $800 of these sales were on credit terms. You gave your customer 30 days to pay. $200 of the sales was done on cash terms. The widgets cost you $500. Because you're a new business, your widget supplier insisted on being paid in cash upfront. Let's assume you sell all the widgets you bought during the month. In other words, you don't have any inventory left at the end of the month. You also hired an assistant and paid wages of $200. Now, let's look at what your accounts show you about this first month of trading. Let's start with the profit and loss. You made sales of $1,000. The widgets cost $500. That's your cost of sales or cost of goods sold. So you have a gross profit of $500. Then you had to pay wages. So that leaves you with a profit before tax of $300. I'm going to ignore the impact of taxes for the time being. Let's assume that income tax is 0. So profit before tax is equal to net profit after tax. So what did this month's trading do to your business's financial position? Your balance sheet as at the 31st of January has grown as a result of the profit you made. You put in equity of $5,000 on the 1st of January, and that's grown to $5,300. Assets have also increased to $5,300. But even though you made a profit, your cash went down by $500 to $4,500, and you've now got an asset called debtors on your balance sheet. To understand what happened with cash, you need to look at your cash flow statement for the month of January. This statement shows you that your operating activities used up $500 of cash because of working capital requirements, specifically because your business had $800 of cash being tied up in debtors. The financing activities section shows the proceeds of $5,000 from equity raising earlier in the month when you set up the business. So your net cash flow for the month is $4,500. And that is exactly the amount that your bank balance changed by from the time you set up the business, just before you put in the equity, and at the close of business on the 31st of January. Now, let's see what happens when we have credit terms from suppliers. In February, your business doubles its sales to $2,000, $1,600 on 30-day terms, and $400 on cash terms. It costs you $1,000 to buy all those widgets in February. When you were ordering your widgets at the beginning of the month, your supplier was happy to give you credit terms of 30 days from the date of invoice. So let's say you were invoiced sometime during the first week of February. That means you don't have to pay for the widgets until sometime during the first week of March. Let's assume you had a complete sellout again. In other words, you don't have any stock left at the end of the month. Your wages bill stays at $200. Now let's see what your financials show you about your business at the end of February. Your profit and loss for February shows sales of $2,000, double that of January, and better still, profit before tax of $800 is more than double that of last month. In other words, the business is more profitable now than it was in January. We'll discuss profits versus profitability shortly. The fact that you got credit terms from your supplier has no impact on your profit and loss. The use of credit terms, or for that matter, the extension of credit terms by you to your customers, only has implications for your balance sheet and cash flow. Your balance sheet now shows total assets of $7,100. That's a $1,800 increase since the 31st of January. That increase is made up of a $1,000 increase in cash and an $800 increase in debtors. This business expansion has been funded by using your own money, the $800 profit, which increased retained earnings to $1,100, and from using other people's money, that's the trade creditors of $1,000. Now, if you didn't have the credit terms from your supplier, you wouldn't have this $1,000 liability, but you would have reduced assets because you would have less cash. But how did your bank account increase by $1,000 when you only had $800 in profits? Look at your cash flow statement. It shows you an $800 increase in trade debtors. Increases in trade debtors tie up cash. That's why it shows as negative in the cash flow statement. Now you know that a pretty high proportion of your sales are on credit terms, so the increase in debtors from February's sales should be much higher than $800. In fact, new debtors from credit sales in February was $1,600. The fact that the increase in debtors is only $800 means you have received debtor payments during February, and presumably it's all of your January debtors. I say presumably because you don't actually know who paid you or didn't pay you until you review the report called the Aged Debtors Listing. I'll get to what an Aged Debtors Listing is in a moment. The $1,000 increase in trade creditors means your supplier effectively provided you with funding during February. You got widgets to sell without having to pay for them first. The net effect of the timing differences in receipts and payments of your operating transactions ended up generating positive cash flow of $200. This cash flow generated by working capital movements together with your net profit figure gives you net cash flow from operations in February of $1,000. There are no investment and financing activities in February, so $1,000 from operations is your net cash flow for the business for the month. And that reconciles exactly with the change in your bank balance between the 31st of January and the 28th of February. Let's look at profit versus profitability. Gross profit is the profit you make after deducting the cost of goods sold from your sales. You still got to cover overheads and other expenses. Profit before tax is the profit your business makes after deducting overheads and other expenses, but before paying income tax. In this example, we've only got wages as an expense. All these profit numbers are absolute numbers. You do need to know whether your business is making a profit or not, but these numbers don't show you how profitable your business is. Profitability is about how efficient your business is in turning your sales into profits. That's where ratios come in. Gross profit margins give you insights into how your business is pricing its products. The gross profit margin is the ratio of gross profit to sales expressed as a percentage. A 50% margin, as it is in this case, means you are marking up your products by 100%. The net profit before tax margin tells you how efficient your business is at turning your sales into profit before paying income taxes. It is the ratio of net profit before tax to sales expressed as a percentage. In this example, you achieved increased profitability in February. Your profit before tax margin is higher because even though you doubled sales, you haven't had to pay out more in wages. So your business is now converting more of each sales dollar into profit. Using margins enable you to benchmark your business's performance in a far more meaningful way than just comparing absolute numbers. You might be making more sales, but are you making more money out of each dollar of sales than you used to? If you don't achieve the absolute sales dollars that you targeted in your budget, but you achieve a higher than budgeted profit margin, is that necessarily a bad thing? Margins also let you benchmark your business against your competitors regardless of size and against industry standards. Are you getting comparable gross profit margins as your competitors, or is the rest of the industry achieving higher gross margins? Is that because you have chosen to discount your prices or because you are paying higher prices for your stock? Are you achieving better or worse net profit margins than others? You do need to be very careful about jumping to conclusions when doing external benchmarking. Your competitors may have a different product mix. Their business or financial structures could be very different. For example, some may own their own warehouses instead of renting. Some may be using debt in their financing structures, and others may not. However, external benchmarking is still very useful as it gives you a feel for what your business should be achieving. Now, let's consider a different scenario for February. What if none of your January debtors paid you during February? Your profit and loss doesn't change, but there's a big impact on your balance sheet and your cash flow. First, your balance sheet. You still have $7,100 in total assets, but the composition of the total assets is quite different. Your cash is now down to $4,700 instead of being $5,500 in the previous example. Total debtors are now up at $2,400 instead of the previous $1,600. So, although you made $800 in profit and you got credit terms from your supplier, your cash only increased by $200. Your cash flow statement tells you exactly what happened. Your business now has an additional $1,600 tied up in trade debtors instead of $800 in the previous example. Instead of working capital throwing off cash, it now chews up cash of $600. So you end up with net cash flow from operations of only $200. And that's your net cash flow for the month, which is why you only have a $200 increase in cash despite the good trading month. Let's see what's going on with your trade debtors by looking at your aged debtors listing. The aged debtors listing is a report that can be generated from any accounting system. Make sure you look at this report every month as part of your business review. This report gives you insights into the quality of your debtors, a key asset in any business. You should have processes in place to manage debtors very tightly. A sale is not a sale until you get the cash in. This is an example of an aged debtors listing. The aging periods, current, 30 days, and so on, are common age periods, but it's not cast in stone. If you sold on 14-day terms, it might be useful to have a column after current to show debtors that are older than 14 days, but less than, say, 30 days. Current means that they are still within terms. In this example, you can see that none of your debtors from January have paid you and still owe you money at the end of February. Now, your terms of trade is 30 days, so these customers are now way overdue with their payments. Somebody should have been calling these customers to follow up payment of overdue amounts within days of payment due date. Sometimes customers may not have paid because of some issue with your invoicing that didn't meet their internal processes, or there is some issue with the product. The earlier you find out and fix any problems, the sooner you'll get paid. You can also see that 2 customers who haven't paid you from January bought more from you in February on credit terms. Should you still be extending credit terms to customers who don't pay their bills? In the aged debtors listing, you can see that customer number 1 is now your largest debtor, representing 25% of your total debtors. This raises the issue of concentration risk. You have potentially higher financial risk in your business because if a major debtor like customer number 1 went broke, you will have a bad debt of $600. Losing 25% of a major business asset, $600 out of $2,400, has huge implications for profits, your balance sheet, and cash flow going forward. You have to pay your supplier for those widgets, but what are your chances of getting your widgets back from customer number 1 to sell them again to someone else to cover that loss? Even if major customers are high-quality blue-chip corporates or government bodies which are unlikely to go broke, you still have to consider the increased business risk arising from customer concentrations. What if 80% of all of your sales came from only 2 customers and one or both of them suddenly decided to take their business elsewhere? Concentration risk can be an issue when you're seeking financing because of the higher business risk as well as the potential financial risk. It's something that financiers look at very closely. As business owner, you should be pursuing strategies to diversify your customer base to minimize concentration risk in your business. Trade creditors are an important source of working capital for a business. For example, in February, if you didn't have credit terms from your suppliers, the cash flow impact of the delays in debtor collections would have been magnified. Working capital requirements would have chewed up $1,600 of cash flow. So even though you made $800 in profit, your net cash flow from operations would have been minus $800, and the bank balance would be much lower at $3,700 at the end of February. It's important to manage your trade creditors as tightly as your trade debtors. Make sure you get an aged creditors listing report with your financial statements every month. This report is like the aged debtors listing except that it lists your creditors, the businesses or people you owe money to for goods and services provided to your businesses. It does not include your financiers or the tax office. Trade credit is the cheapest form of unsecured financing that you can get for your business, but that doesn't mean that you treat your trade creditors as your banker. If you have large amounts overdue or are constantly late with payments, suppliers can put you on cash on delivery terms, or worse still, refuse to supply you until you get your account back in order. You don't want them sending your account to debt collection agencies either. You could end up with adverse credit reports, which makes it even harder for you to get credit terms from other suppliers in the future. Financiers will always want to see your latest aged creditors listing. A high level of past due amounts is a sign of financial stress. Banks don't like lending you money to pay out trade creditors. Concentration risk also applies to creditors. Are you heavily reliant on one or two suppliers? What if they went broke? How quickly can you establish a new source of supply? To recap what we've covered in this video, profitability ratios give you much greater insight into your business performance than just numbers alone. Working capital items such as debtors and creditors have a huge impact on your cash flow. Tight management of both debtors and creditors is essential to ensure that your business is highly efficient at converting sales into cash. The quality of your debtors and creditors have financial and business risk implications. Your monthly business review should always include a review of aged listings of debtors and creditors. Financiers look very closely at these reports, and so should you. I strongly recommend that you review your financial statements within 15 days of month end. It's easier to fix problems when you get to them early. If you want more information about business financial reviews or about financing in general, please put your questions below in the comments or contact me through the contact page at incontextfinance.com. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.